Welcome to the Dividend Talk podcast, episode 283. European earnings with strong results and sometimes even stronger dividends. Hey, European DJI, another busy week.
Yes, definitely. I mean, the stock market is really treating us well, I would say. I mean, stock prices are coming down in certain areas of the market. Others are going up. So effectively outlooks for me. Most of the companies that I have full positions in, they are going nicely up, right? Think about Ahold Delhaize that we speak a little bit more about today. And then you have the SaaS companies, the IT companies that we always felt were too expensive. They are really coming now into this zone. So I'm really happy with that. And this feels for me a little bit like what we had in the past. I remember in 2016, Amazon coming in, wiping out all retailers, supermarket chains. At that time, we had Ahold Delhaize at 16 euros. Later on, we had the oil companies in 2020 that we could nicely gobble up. Then we had the insurance stocks, like the European insurers, like 2-3 years ago, or maybe 4 years already. Time flies fast. And we'll be discussing about NN Group today also, because they had, amazing results. Let's say it like that. So doing really well here. Good week. And I just keep on compounding. So it's nice to be a dividend investor, right? Specifically during these times, because I have absolutely no fear of missing out right now. How about you? How are you doing? You look a little bit, you had a rough night.
Yeah, a little bit tired and cranky. So I might bring the SaaS today instead of you. Apologies in advance. Yeah, but look, portfolio-wise, doing quite well. Companies, Ahold Delhaize, big dividend hikes. We had Brookfield last week with big dividend hikes. So a couple of double digits in the portfolio, which always helps. And then the likes of British American Tobacco, who we'll speak about later as well. So portfolio value-wise, it's doing quite well, but I don't really care about that. I think I've said that last week.
Exactly.
It's more about dividends and dividend hikes. And we get into some of them. We have a few to announce in a bit. But before that, let's start with the news of the week. And it's something that we mentioned a couple of weeks ago. I know you felt quite strongly about it. I'm sure that sentiment has not changed. But it looks like that the Dutch government officially passed this law about taxing unrealized gains.
Yes, they passed it. So when you're Dutch, screwed, effectively. You will have to pay, and I checked also on dividends in the end, 36%, because it's all treated as income from box 3. Oh yeah, you're screwed. It's no easier or nicer message than that we can give. It will take I think 1 or 2, I think from 2028 it will be really implemented. It's considered a temporary law, and they want to really go to taxing realized gains. I believe they need to just fill the gap of almost 2.5 billion deficit on the budget. So yeah, let's take it from the working middle class that is trying to build a little nest egg for later. And interestingly, they're also trying to reduce the unemployment duration from 2 years to 1 year or something like that, and also reducing it to the people that are in the middle class. So it's really double whammy. Yeah. First of all, it's quite ironically, many people that invest are doing this to build a nest egg for later, so that they are less depending on the government. The government starts to make that really hard. And with that, if you now get unemployed or in retirement, you'll be more reliant on the government because of that. And the government is also, lowering the money you would get at that moment in time, or increasing the retirement age. So I'm afraid that many more Dutch people over the next decade will become much more reliant on the government than it already is. And the deficit to fill the holes in the budget will only become bigger. We know how this goes with companies, right? You just need to restructure at a certain moment. If you're on a path of decline, you need to find new ways of earning money. You need to do innovation. Innovation is typically the way to do it. Or you do acquisitions. Well, I would not recommend countries to go on that path in Europe, but I would wish there's a little bit more entrepreneurial spirit there. There's only so much you can do becoming fatter and fatter. And this is not about being political. I'm really looking at it here from an economical point of view. Yeah, and this is not a good path. It will really take the incentive away to build something for your own. You can go to the other box and start a company and such here for your investment vehicle. But come on, guys, do we really need to go into that path that people need to start to take a lawyer in hand and an accountant in hand to set up a company for all of this? And I mean, it's just crazy.
Yeah.
It's so crazy, Derek. I mean, I'm happy, really happy that I'm not faced with this. In Poland, we will soon this year get this investment vehicle that looks a lot like what we have in Sweden. So much more tax efficient to invest, and they really want to stimulate the investment climate that people start deploying money in the capital markets in Poland so that Polish companies get better access to capital. I mean, isn't that what we want? I mean, that's the direction that we should see. So, I mean, even though I don't live in the Netherlands, I'm Dutch by nature, right? It's really, this one really works on my nerves, right? Because this is a spillover potential to other countries. And look at France already, what we discussed the other day, right? That companies that make more than 3 billion in profits are taxed by 40 plus taxation, temporary taxation now for the second year. It's just crazy. It's crazy. They're really looking at anyone that has some money left somewhere to take the money away. And this feeling of that it's not fair or something like that, or about solidarity, but solidarity needs to come a little bit two ways, right? So, yeah. Before I start the whole rant, someone posted on Facebook already, like, what do I think about it? I said, hey, do you want to get my typical EDGI rant again? Well, here I am. Utterly unbelievable what's happening in the Netherlands. And I know I'm probably feeding this sentiment even more, but, you know, let's whine all together about this and face reality because it's tough. And be solidar to our Dutch brothers that are trying to invest in dividends. I mean, crazy.
You touched on it. I think from a European perspective, looking in, the fear is that the Netherlands is a test bed here. And we've seen Europe do that before. We've seen the smoking laws, for example, start in Ireland. And then when that's successful, it filters out through Europe. And it feels that this might be something similar, which as investors looking in is quite scary because it doesn't impact the super rich or the wealthy, those that are globally mobile that can just up their assets and move them somewhere else.
Exactly. This is the middle class.
It hits us pretty much. And it's easy for people looking in to say something like, I would move to another country. Put yourself in that situation. No, you won't. You've got family, you've got work, you've got commitments, you've got friends. You can't just up and leave for the 200k portfolio or 300k, whatever it is, small portfolio. Yeah, I mean, all the middle class want to do is to try and get ahead and not rely on the government. And all the government want to do is push us down and rely on them even more. So it's strange. As I said, we have it with deemed disposal in a way. It's not as bad as this. It's only in a certain aspect. It's on ETFs, whereas this is across the board. So we feel your pain. We feel your pain on that one.
Yeah.
But let's keep an eye on it and see. It might create some buying opportunities because these companies are not going to go bust because of a tax change, but they might get cheaper.
Yeah, true. But I am afraid that we will not see a lot of that there because most of, I think, liquidity comes from institutional investors. And in the Netherlands, the pension funds are really, really huge. And we're talking about trillion here probably. So, but okay, I need to switch because if this is the start of the podcast, I mean, people will making accidents because they will be so depressed, speeding up and crashing against the tree. So watch out, guys, if you're driving. We want to make it a little bit more interesting, maybe, or more uplifting, because what I find very, very interesting, it came to my attention this week when someone tweeted about it, that Walmart is at the moment trading at a 45 ratio, nearly twice as much as what Amazon is trading at. I mean, isn't this the total disconnect that we are experiencing in the stock market right now?
What is going on? 45 PE ratio for a company like Walmart. I mean, no disrespect, but if you're buying a company like Walmart at 45 times earnings, I think you're in the wrong game.
So I must confess, they are doing quite well with the digital presence as well. They also start to sell, let's say, white space in forms of ads. Yeah. But come on, this is what Amazon is also doing. And then look at how much Amazon is investing in the future, in robotics, cloud, everything. And then you have Walmart at a 1 trillion valuation. It's crazy. It's crazy. A 0.7% dividend yield with Walmart. All I'm trying to say in my opening statement, I mentioned it's going really well for my long-term holdings that I have full positions in, and quite poorly at the moment in the technology sector, let's say. So when you see this and you see Amazon trading at a 28 PE and you know its earnings power, aren't you interested in, even though Amazon doesn't pay a dividend yet, I think it will be one of the next ones at a certain moment in the next few years, aren't you interested in kind of starting to look at Amazon?
I mean, Based on that argument, 100%, it would make sense to look at a company like Amazon, giving their growth profile compared to someone like Walmart. I still think 28 PE is a little bit high for Amazon. I know it's a growth company. Probably people are used to paying 28 PE for that, but I'd rather a little bit lower. Yeah, I mean, come on. If you were to compare both of them, Amazon is the clear winner in my eyes there. So makes
And when you then
sense.
look at what is happening now in technologies, anything coming on your radar that you think like, okay, I haven't been able to look at this stock for 10 years. We know you bought your first Microsoft share. Thanks also subsidized for half almost by the Dividend Talk community. But is there anything else on your radar then? Or is it just totally oblivious to you?
A little bit oblivious to me. I'm in my little bubble of dividend growth investing. I've said this before. I fear if I start deviating from that and focusing on growth, I'm too early in my journey for that.
But I would argue that ADP is also in the bucket of the technology industry. If you would look at the classifications and everything. You have ADP, you have Wolters Kluwer. These are companies that heavily rely on recurring revenue, SAP as well. So it's not just only the Amazon or the Workday or the ServiceNow of the world. We're also talking about these other businesses that generate maybe 80-90% via a SaaS kind of revenue model.
Yeah. I kind of look at the other way. I look at the infrastructure around AI, what can benefit because of AI, rather than what potentially can disrupt it. I mean, there's fears obviously around Wolters Kluwer or ADP that AI can disrupt it. Maybe it will long term. I don't have a strong enough conviction around those business models to say it will or won't. Yeah. I don't think it will in the short term. I mean, AI is accelerating quite fast. I'm reading a lot of articles over a while. I know people in some companies, some of these growth companies actually, where employment has nearly been wiped out by AI. So I can see real impact in that. I won't say the name of the company because I don't know how public that is, but there's a real impact starting to happen by AI. And that's clear. It's way faster than I thought. They're talking the change in the next 5 years will be astronomical. So there's a lot of disruption that can happen. I don't know if it will, but can. So I look at it at the other side. So what can benefit from this? And this is why I stick with more the infrastructure type companies that are needed and required to help grow AI.
So more the shovels of the industry.
Exactly. I prefer the shovels. It's a little bit more safe, a little bit more within my risk profile. And maybe when we start to see some clear winners and how they transition with AI, it might be time to get in. But yeah, I need to sleep well at night too. So
you're more into the Schneider Electrics of this world, the utilities that are supporting energy consumption.
Schneider, Siemens, and even down to someone like Brookfield Asset Management, which own the infrastructure around delivering power and those types of companies.
Yeah. You're more conservative as an investor than I am. That's what I hear. But very interesting. You gave me some food for thought because I'm really looking into ADP, Wolters Kluwer at these price points. They're very attractive for me, and I have enough conviction around that. I see that they really own very important data sets, which are curated by lawyers for decades. Once you go into the decision making, I've spoken with a few lawyers, they will rely on that information in the end. I think AI as a layer around it has a lot of potential. That's why I was really interested in Relax that announced earnings this week. And I would advise everyone to go to the earnings call, the transcript, because they talk about AI. I just see a very strong utilization of this and also an interest by the customers. Yeah, there's a threat, but that's why these shares are being repriced. And you know what it means, right? Sometimes the baby gets thrown out with the bathwater, and that's how I look a little bit at ADP and Wolters Kluwer here.
Yeah. Exactly.
We didn't do the disclaimer yet about investment advice and such. I'm long both those stocks, of course, and this is only for entertainment. But
Yeah. I can see both sides, and that's where conviction. We always speak about conviction. Can't borrow conviction, and yeah, I admire your conviction on these companies because I have to say I'm quite close to you, and I can see how passionate, but also the work you've put into understanding these companies. And like, I trust you, but I know if I bought them, they'll not sleep well at night, and the first sign of panic, they will be the first to go out of my portfolio. So
I wrote quite a piece about it in the latest newsletter, right? For the premium subscribers, nice. Based on René Selman. He had a nice article of 5 questions you can ask to your investments. I looked at a few stocks like those and wondered, okay, how does it relate to this? And then that just helps. Yeah, just zoom out, and just look at it and what's really the situation here. And if you buy 4 or 5 stocks, one may go bust 5, 6 years, 10 years from now. That's true. But the others pull up, you will do fine on average.
Exactly. Look, there's plenty of opportunities in that space. It's just finding the right one.
Yeah.
So dividend hikes, and we're in that season where we have lots and lots of dividend hikes. So we'll fire through these as quickly as possible. Fielman AG have a dividend hike of 21.7%. I'm not familiar with the company, but I'm sure this came from social media.
You don't wear glasses. It's one of Fielman is one of the biggest how is it in Germany that with the shops for glasses, right? Yeah, they do these eye tests and everything. They have actually they are growing quite nicely over the last few years. They really have a European expansion in mind. They did cut the dividend. It was €1.50 in 2021. There it's now back at €1.40. So it's not a reliable dividend payer. I mean, if you look at their Capital Markets Day and what they are presenting, it's not too bad of a company if you are looking for a little bit of growth. I don't know what the valuation right now is, but they have quite an expansion desire.
Yeah. Seems more and more people are starting to wear glasses and so on. I have glasses. My wife will kill me. I don't wear them as much as I probably should. But I feel once I start wearing them full time, my eyes will deteriorate fast. So I'm training them to not rely on glasses unless I need. Anyway, Brookfield, ticker symbol BN, raised their dividend with 17%. And this is, remember, BAM, which is like a subsidiary. Brookfield own 75% of them, raised their dividend 15% last week. So quite nice dividend hikes from Canada at the moment. Dutch insurer, which we are probably well known for at this stage. NN Group, you did a nice post on social media with people dancing around at this hike, but they hiked their dividend by 13%. I was expecting a strong hike, but 13%, this is another double digit.
Blew my mind, 13%. Yeah. My yield on cost is now 10.8%, Derek.
That's crazy. We were buying this company at $30 or €30.
Yeah, even under, right? It went in the low 20s, I believe, when they had this issue with this group that was reclaiming some because of the life insurance usury policies that they had. By the way, I'm getting €500 from it, so I get an additional dividend payment. It's already covered. It's talk about later a little bit about NN Group, but yeah, I was really having this kind of like, yay, party feeling after this one, because it matters. If it's already giving you lots of dividend income, then I can't compete with my salary on this. It's really simple. I can't.
I mean, if roll it back to 2020 and tell me what I know now, I'm going 100% in on NN Group.
Yes, and ASR. Sets also expectations now for ASR, right?
Yes. And they usually follow, but a little bit lower, maybe 8-9% with ASR. Let's guess. Hermes, the goat of luxury. I mean, when you mention Hermes, that's all you think. You think of scarcity, something that I'll probably never own in my lifetime. But they had a nice dividend hike of 12.5%. And I always find that interesting when you compare that to like the middle class luxury, which is LVMH, which
middle class luxury. I don't have Well, I do have LVMH suitcase. Yeah. But this was one like before they got acquired with Remova.
Yeah. But it's just interesting to see the luxury brands. L'Oreal actually had a 2.9% as well, which would be luxury in terms of lipstick. So it's interesting to see the dynamics between them. Manulife Insurance raised its dividend by 10.2%. Nextar Energy, ticker symbol NEE, which was Jeremy on our show talked about this one way back. One of his favorites, I believe, hiked its dividend by 10%. A lot of double-digit hikes. Relics, which you spoke about, hiked its dividend by 7%. Ahold Delhaize, which we'll speak about later, hiked its dividend by 6%. And we had a bit of a thing online about our OCD, how much they're going to increase their dividend. But disclaimer, they've surpassed their expectations. Logis PLD raised its dividend by 5.9%. Phillips 66 hikes its dividend also by 5.8%, close to 5.9%. Tractor Supply had a 4.3% dividend hike. T-Rowe Price had its 40th consecutive dividend growth with only 2.36%. A lot of people speaking about that. I saw it mentioned on our Discord whether we are selling or holding. It's kind of underperforming and so on. So disappointing hike, I would say, but not unexpected given their troubles. And then a 2% raise from British American Tobacco, and I will speak about them later, so I will get more into that.
You still missed two stocks, my friend. Unilever, 3% dividend hike. So they continue being back on track. A little bit underwhelming, but they're a lot in transition. And L'Oreal only 2.9%, but we know what's happening there. LVMH kept the dividend flat. So I appreciate the little bits, but 62 years of dividend growth, at least that's how far I could get. Yeah. Occasional flat year, but let's not forget about this one as well. In the end, if you can make people and specifically women feel more beautiful for over 62 years and earn money from that, you've got something going on in your company.
Yes. I mean, I saw online actually from Dividend Hike, that Twitter, that there's been over 200 dividend hikes this year.
Wow.
So it's quite a start, and a lot of big increases there. I'm looking at Brookfield, looking at insurance.
Mm-hmm.
Yeah, it's quite a good start to the year, I would say. Anyway, we have some earnings. We're still in earnings. This is our third or fourth week talking about earnings, but now we have a European focus. European companies are starting to release its earnings. We're starting to get those dividend increases, which we'll get around May or June. I can't wait for May and June. I can't wait. But let's start with Dutch insurance company. I mean, Dutch seems to be part of this team. We spoke about it in the news of the week. You're Dutch. Talk to me about NN Group. How did they do?
Yeah, they actually, I kind of blew me away with their performance. You need to know that they report something called operating capital generation. It's kind of the free cash flow version for us, or EBITDA, if you want to call it like that, for them. Yeah, and effectively it tells you how much money they made that they can really provide to their shareholders, in terms of capital return. So their guidance was 1.9 billion and they made almost 2.1 billion. So that's like a 10% overachievement, right? They also have the real free cash flow here, 1.62 billion versus 1.6 billion here. And here it comes. The balance sheet, the Solvency II ratio, that's really what you look at when you're assessing insurance companies. 220%, Derek. Usually the threshold for a safe dividend is around 150%. Yeah. So yeah, that's why they were able to increase the dividend so much. Yeah. So if you really look at it, what business unit was really driving it, and it was just the Dutch life insurance group. They grew their OCG, right? This kind of optimal capital generation by 13% last year to nearly 1.2 billion. That's really, really a lot. Overall, it grew by 8.7 billion. So these are numbers you usually don't expect from boring businesses. Yeah, and this life insurance business unit is already the largest one, making around 50% of all capital generated. And then also to grow by 13% is really amazing. Yeah. Now, where did it come from? It was mostly the investment result. Yeah, plus a little bit of higher profit margin. And this is why Warren Buffett really likes insurance companies, for the float. Yeah, you get to invest other people's money, but you get to keep the returns if you have a good year. And that's what's happening here. And that allows them to strengthen the balance sheet. So last year at the annual report, they had 18 billion in own funds. Now it's 19.6 billion. From a solvency capital requirement point of view, they only need to keep 8.7 billion. And so their solvency ratio went from 194% to 220%. That's a big bump. You need to think about it as your own balance sheet. Yeah, like, okay, you need to have your emergency fund. Yeah, and then you have 2.2 times more on your cash account, let's say, there to cover an unexpected event that goes beyond your emergency. Yeah. That's what we're talking here, if you want to make it really practical. So no wonder that they feel like, yeah, well, we really don't need to have 250% solvency ratio. We're fine with 200%. Yeah. So let's give a little bit back more to shareholders. They decided again to buy back 350 million in shares. That's 50 million more than last year in the annual buyback. They also decided then to increase the dividend by 13%. The buyback yield at the current share price is about 2% on an annualized basis, and you still get a 5.7% yield or so. So we're talking about a 7.7% yield shareholder yield if you will buy today, which is really good. And then we're still talking about a growing business. Of course, they're benefiting also from higher interest rates and everything. So it may not always look so nice. There may be a little bit of a few worst years, but if you look at it, I mean, this one is where the cash is literally slashing against the walls, and yeah, instead of smoking it up and stupid ideas, they're nicely giving it back to us as shareholders. So I'm very happy with this one. It sets the tone also for what I'm hoping to see more. ASR, Allianz, let it come, baby.
Yeah. When I look at that balance sheet, the solvency ratio, I mean, it's quite strong. I can't remember what their target is. I get confused between the different insurance companies. I know some of them are around 180, some of them are 200. So at 220, there's still a lot. They could have increased it by 15% and still be well within reach. So yeah, phenomenal company, I have to say at the moment. But probably leads into one of the questions we got from Kabuza24. A long kind of question, but if I was to break it down, the main question is, how can NN Group keep performing strongly over the long term despite heavy competition across Europe? And there's a couple of sub-questions within that. So do the growth metrics really support long-term growth? I think you touched on some of that. Can they become an industry consolidator? What actually drives long-term performance in insurance, and how does the insurance business model evolve in a competitive environment? What I will say is, first of all, you did an excellent piece on how to analyze insurance companies. We also did a webinar on it, but you did a piece on it and some of the key metrics on our premium subscribers service. It's really, really good. It breaks down, I would say, in quite simple English, what to look for for these companies. And it would answer a lot of these questions. I would say, do their growth metrics really support long-term growth? I mean, you touched on that. Yes. One thing you don't really touch on probably is the combined ratio, or like how risky is their underwriting profits. And our combined ratios is quite strong here as well. So I think long term it does show growth, which I think you explained. But the interesting question for me is, what drives long term performance over time and how does it evolve? What are your thoughts on that?
Oh, really simple. The increase in insurance policies. Look at car policies. I had a call with an insurance agent this week and said, like, well, sir, the price that you had last year, we can't offer that anymore because on average in Europe, it went up by 18%. Yeah. Well, if you own a car and you're experiencing these kinds of hikes, then you may want to actually, invest in the company that's offering you those policies, because you may be on the good end there. Yeah, so that's how I look at it. And with all the uncertainty in the world, I think it even gives more. I said more people will be having more anxiety and probably even be more interested in insuring things just to protect themselves, their wealth, their family. So I think this is just a long-term trend. And in some countries in Europe, I think there's not yet such an insurance mindset as in the Netherlands. If you watch Dutch TV, it's always for me interesting, right? In Poland, everything is about sneezing and this and this and this, and then the medicines. In the Netherlands, you have a lot about living a happy life, and then you have the Zwitsersleven gevoel, so the Swiss life feeling and such, a lot more targeted on insurance and such. So I think there's still a lot of opportunity in the rest of Europe to stimulate a little bit that culture of being insured, and yeah. So I think there's just a natural runway there that's probably slightly above inflation in the long run.
Yeah, I mean, it's hard to look at insurance companies and see where long-term growth, when you compare them to something like a tech stock, for example. With a tech stock, you can nearly see a clear trajectory, whereas insurance companies are usually probably local-based and heavily regulated. And for me, it's more about capital discipline, or maybe small strategic acquisitions within their locality, rather than expanding and aggressively into other areas. And I think that's what companies like NN Group are doing, and ASR, predominantly in Netherlands. I know they have a little bit outside Netherlands, but they stick locally. The regulation is there. Some of the key metrics that maybe you didn't touch on, and when I think about insurance companies, return on equity, a combined ratio, which is solvency ratio, and then look at the balance sheet. And for me, along with a dividend policy, that's enough for me to say that they do support long-term growth.
And I think if you also look at ASR, I think they're also a little bit more aggressive in taking over these pension retirement schemes from the companies in the Netherlands. So there's also there an opportunity. I think NN Group sees it a little bit less as an opportunity. But again, there are such things going on. So actually even there, that you could consider as a consolidation here. And Yeah, they are like magnets for this. So
yeah, but don't expect it to keep going up and double digit dividend hikes forever and ever. I mean, we were quite lucky getting in early, but yeah, there might be some period of turbulence, especially they're benefiting from high interest rates as well at the moment. So just bear that in mind. I know we're quite bullish and we can seem like that. And I spoke to some people who are talking about N Group as new investors. And I just want to highlight that the risk is there. They're not going to keep growing. I don't see them doubling in share price in 3 years like they did over the last 3 years. And I don't envisage 13% dividend hikes year over year either. It will normalize, I would imagine, at some point. So I want to give that disclaimer. Anyway, let's move on to British American Tobacco. I spoke about Altria on the show a couple of weeks ago. If you remember, I was quite disappointed. And when you look at the top line numbers, there's a lot of similarities between both companies. We can see that revenues are down from, combustibles, and that's no secret. Revenue overall was down 1%, which we saw similar with Altria, I have to say. But their EPS was up. The big difference between the two, which I said, is their new categories and how they handle both of that. So look, I'll just give you some of the summary of their numbers. So they added 4.7 million customers to smokeless brands, which is up to 34.1 million. Smokeless products now account for 18.2% of group's revenue, which is quite strong. Not as good as Philip Morris, but still, I would say, quite good. What's more important there is that that kind of category that actually went more profitable last year. So now it's not losing money anymore. It is a profitable business unit, which is quite important. I don't think that Altria is quite there on that yet. So the main story for me is all around that. The dividend hike was 2%. And if you look at the free cash flow, it would be, I've wrote down, it was negative this year by about 1.2 billion. So operating cash flow was 4.4 billion, but then there was some one-off litigations against them, primarily in Canada, where they had to outlay 2.65 billion. That's always the risk with these types of companies, that it's classified as one-off, which it is in this case, but there's always litigation risk and it can impact the free cash flow. So they did give us a small dividend hike of 2%. Given that they had to go into negative free cash flow, that makes complete sense. I actually would not even mind it if they kept it flat in this instance, but they raised it 2%. Next year, they are saying that there's going to be 3 to 5% growth on new category, which is decent, I would say. Some key numbers then, as I said, between them and Altria is all around that new category, I would say. Smoking is a declining business, remember. So revenues are going to drop there. So it is how they navigate that side of the business. I think Philip Morris are definitely the leader. British American Tobacco are doing quite well. I think their brand Velo, I'm not too up on my smoking products, but Velo is number 2 in the US by volume, which is quite impressive when you consider there's a lot of knockoff brands, I would say, or brands that are not owned by tobacco companies. And I know there's a lot of talks in the US between the major companies, how do they mitigate against this and bring in laws while selling their own products that can do something similar, which is quite ironic. But yeah, look, I think overall, I think it was quite a decent report from British American Tobacco. Happy with how their growth is going in new categories. Probably wanted to be a little bit more aggressive and get it towards the 50% mark like Philip Morris. But I mean, if you compare it to Altria, which I quite do, because I had 2 of them, I sold Altria recently, and I think British American Tobacco are in a good place.
And think about all the listeners that have been buying British American Tobacco last year at £25, so the year before.
It's at something like I don't know in pounds. I think I have the ADR, but it's at $62, $63 at the moment.
I think it's in the £40 now, 44, something like that. So that was an opportunity. And my God, it's always easy to spot the opportunities afterwards, right? Like NN Group and British, and so much more difficult to buy them at that moment in time. But for me, British American Tobacco was quite clear. We wrote articles about it as well. And sometimes you have this feeling, right? It's like you're in the eye of a tornado. Yeah, everything is spinning around you, but you see it so clear. Yeah, and for me, that was British American Tobacco there.
Yeah, for me, the opportunity, the share price that has happened, I did not expect.
But no, it went really ahead of itself. That's how it feels,
yeah. But the opportunity for me, it was nearly 8-9%, nearly 10% at some point.
Exactly.
When I was buying it. The growth at the time was 3-4, sometimes even 5%, which I would expecting around a 5% hike if if they didn't have that litigation.
Yeah.
So you're getting a high yielder with some decent growth. They still give me 2% growth. So it's more the opportunity with the dividend safety with that income. That's where the opportunity was for me.
Because they didn't have an 80 or 90% dividend payout ratio, right? It was more around the 50-ish at the time.
50, 60%. And
yeah, look at that.
So again, it's all about execution here, and they're doing that quite well. And I'm really disappointed with all three because they were kind of the first movers in all of this. And I mean, it's a brand that they know, but they are relying heavily on Marlboro at the moment, whereas other companies are starting to diversify out and moving into new categories faster, better, and focusing a lot more on it. And it just looks like all three has been left behind. I know Dividend Wave was on this. He's more of a tobacco industry expert, so I'd like to get his thoughts on it. But yeah, quite happy. As a shareholder, I'm quite happy with British American Tobacco.
Good. Well, I'm still happy also then about the next company, Derek, and we have to talk about Ahold Delhaize. I think our show is known for Shell, Ahold Delhaize, and NN Group. I think these three Dutch companies, I will still call Shell Dutch, are kind of iconic companies in Dividend Talk. So skipping them will be a little bit hard. But look, I will keep it short actually on Ahold Delhaize because it just hit the mark on everything. Yeah, and I want to talk a little bit about what the guidance was, and that shows you a little bit like why this was a good year. So they expected around 4% operating margin, and they did 4%. Underlying EPS growth, that mid to high single digit growth, they did 5%. But if you wouldn't look at the dollar, it would have been 7.8%, right at the mark. Capital expenditures, they were thinking about 2.7 billion. They did 2.6 billion, a little bit less. So they saved something there. Free cash flow, they were expecting 2.2 billion and they did 2.6 billion. Yes, so they did much better here. That's a 400 million more. Dividend, they increased by 6%. They just announced a year-over-year growth. They did that. Share buyback 1 billion. They did it. And then they have this they want to save money for the customers. So they were thinking about 1.25 billion, 1.3 billion. I mean, this is like an A-rated, if you have your end year at school, these are only A's. Yeah. So they passed on everything. And this is what you don't see a lot lately. Many companies, specifically consumer staples, are having decline here, decline there, decline here. And Ahold has been just hitting the mark on everything. So the price also shot up, of course, 38 euros. It went to a little bit on the high end for me, but that's amazing. Yeah. The delivery is fair. That's what I was very surprised with, because they had years like that they weren't even transparent about what happened to the free cash flow, and that they had this Belgian windfall, right?
Yeah. One phrase always comes to my mind when I think of Ahold Delhaize, and you said it when you brought this company up way back 2020. One of the first times you're speaking about this company, telling me to look into them, and it was UPAD, under promise, over deliver. And I think this is what, our 6th year doing this.
Yeah.
And it's the same thing every year. We spoke offline on social media, even on Discord, they were speaking about the growth and the struggles in the US, and everybody was kind of expecting a little bit lower than what they did. But the fact that they've hit the mark, given so much pressures on them at the moment, I think it's outstanding.
I mean, 2.7% in the US comparable sales growth. Yeah. 2.4 in Europe. And then if you look at the net sales, it went up in 2005. It went overall up in the group 3.4%, but 11.7 in Europe. Now, there's a disclaimer there, because for the first time they could use the Profi earnings and revenues also in the numbers. So that's why it may also look a little bit different. But if then the free cash flow is going up by 22% year over year, and the diluted underlying EPS, so their number by 12%, then you can say that this one is almost accretive from the get-go. Yeah? And that's how you like the acquisitions to be.
Yeah. And then you talk about innovation, and I remember you speaking about them being one of the first companies where you could bring around a scanner and scan as you go and stuff like that.
Well, it was actually the app. When I was living in the Netherlands 15 years ago, you had the Ahold app. I think it's called EPI. And you could just create your shopping list, and then it was ordered on the floor plan of the supermarket. So you could just walk through the building and tick off in a very natural, logical way. I'm now living here in Poland. I don't have this at the Lidl. Yeah, I have my shopping list. I'm going back and forth to the shop all the time. Yeah, so annoying. They fixed that problem already 15 years ago, and you can only do that when you have excellent inventory management, an excellent connection to how. So let's say that you know exactly where stuff is in your shop. You can only do it that if you have that, and they have it on a data level. Yeah, and I think that's what makes this company so special in operational excellence.
They know what they're doing, and then we speak about AI all the time, and how does a company like Ahold Delhaize use AI? And they have this new feature where you just take a picture and it bang gives you all the relevant. Yeah, brilliant. I think it's a brilliant idea, and I'm surprised Amazon don't have something like that. Like, imagine how powerful that is. You're walking around the street, you see something, picture. You don't even have to search for it anymore. You just take a picture and it just gives you all the matches. It's something simple, but I think it just makes your life easier. If it makes your life easier.
That's the user experience, right?
Yeah.
Yeah. And when you have an excellent user experience, you can afford premiumization. It's as simple like that. So, hey, really good earnings. I'm really happy with Ahold. I think we will not get such a strong execution each year, but very happy with my position. And I still remember putting the buy order at around 16 euro when Amazon bought Whole Foods and they would wipe out every grocery chain in the United States. Remember, it didn't happen. Ahold is still existing there and it's flourishing in the United States. Think about that now also when thinking about the AI threat and looking at all those technology stocks being hammered right now. Do your homework. Try to get clarity of thought. Opportunities are being created right now.
Exactly. Okay, so one more quickly. I won't go too much in depth, but we have to speak about Siemens. It is a European giant company. You know, I wish I backed up the truck at 100. It was kind of a meme at the time. We had AT&T under 30 and I was messing saying Siemens under 100. But man, was I right. Siemens under 100 was a bargain. Just look at their highlights from quarter one 2026. Their orders was 21 billion, which was up 10% year over year, which is impressive. Revenues is 19.1 billion, up 8%. Free cash flow was down, but there was a lot of working capitals and offset tax and stuff like that. So I'm not too concerned about that. But look, strong growth overall. I think smart infrastructure and digital industries are two of the main hitters. And I spoke about that 2 or 3 years ago. I really felt those were the two that would really lead the charge here, and that seems to be the case. So yeah, overall execution quite strong. As we move into AI, like they have partnerships with Microsoft, they have partnerships with Nvidia. You talk about shovels, I think Siemens are at the heart of that as well. So really strong company, revenue growth, plenty of orders in the back line, and plenty of tailwinds to help them grow in terms of industry and smart infrastructure. So yeah, a company that I wish I bought more of, quite strong. Kind of price anchored a little bit like I would say Schneider Electric, but I'm starting to add slowly into Siemens again because I think it's well positioned for the next 10 years.
When you say slowly, does it mean you're buying or does it mean like you start to look at it again?
I've started buying the odd share.
Okay.
Because when I invest monthly, and if I have enough money for one share or a fractional share, I will buy a little bit of Siemens. It's not value. It's not like value at the moment, so I'm hesitant to go all in at the moment. But yeah, I want to keep.
They give a 2% dividend yield, right? 2.1. So it's not like the biggest starting yield. Yeah, nice one. I mean, this always with these kinds of things. I mean, for me, it's like 2.5 times for what I bought it. Yes, so of course I should have bought more. You know, you're always cash constrained by your monthly purchases, so that's what it is. But hey, we discussed 4 European powerhouses here. I own 3 of them, so full disclosure, and then Group Ahold and Siemens. So yes, I am biased, obviously. Do you own all 4 of them?
I all own.
You should be called the European dividend collector on social media.
Yeah, I think European companies are the bulk of my portfolio, nearly tipping towards 60%. If you include UK on that, it's definitely even more so towards 65%. So yeah, more European based.
Good.
We have to do a European perspective, don't we?
Exactly, and a European flavor. I think we gave that also enough already today.
Yes.
So question time.
Go for it.
We couldn't do a lot of the questions last week. It was just too much. So first of all, let's get started with Jason Rose. quite engaging with him on Twitter. Nice guy. He also wrote a book on, I think it's available on Amazon. So do reach out to him if you're interested. Jason Rose, his name is. And he didn't really had a question, but he wanted to give us a reminder, which I really liked. In a down market, if it continues, stick to your plan, build your own version, goals and timeline, and then stick to it. Small tweaks. Okay, if they still match your original thesis, no panic. Keep compounding. I believe that he is already early retired. So these are words of wisdoms that I think are worth repeating, not just by us who are not there yet, but by someone that actually did it.
And do you know what, Jason? I mean, questions every week from Jason. He is retired from this. It'd be great to have him on the show and talk about that, talk about his experience, how it changed in retirement, because I'm always curious. We talk about this all the time. I mean, how your mindset changes. So why not share your journey and inspire plenty of us that are on the journey aspiring to be.
Good one. Open invitation.
Yes. Lawrence has asked us, what would you do in a situation where you are fully invested in a US company? You plan to hold for the long term as you believe in the company, but due to the weakening of the dollar, you are down a decent amount on your position. Would you be tempted to buy more even though you have a full position to help with the dollar cost average?
No,
me neither.
No, I'm really sticking to my plan there. The dollar goes up and down. So just because then my position is going lower to throw more money on it, it means that if it goes up again, I may get more risk in my portfolio in terms of exposure to single companies. So I'm really strict to that one. For instance, I would love to buy more HP Inc. at the moment, around $19. Come on, I bought everything like in between 25 and 30, maybe an occasional low 20s, and now it's at 19. I mean, I still have the same conviction, and I feel really annoyed that I'm limited by my rules right now. But I might be wrong. Maybe this company is going to shite, and then what? I will be happy that I didn't throw more money at it, And now you get to buy it at $19 at a better dollar currency.
I think the thing with rules is, I mean, if you don't stick to them, it's great until it doesn't work, and then when it doesn't work, the first thing you will always say, and I see this all the time, especially in the trading community, right? Let's say that much. The first thing they'll say is, I didn't stick to my rules. This time I'll stick to my rules. It's the first thing, because when it goes tits up, that's when you say, I should have stuck to my rules. If you were to buy more of this company and it does well, you can say you're a genius. Brilliant, I got it right. You didn't follow your rules, really. I mean, you're just taking on more risk than what you said you would. And for me, investing is all about risk management, and you have to be comfortable with the risk that you take. I spoke about people in the tech sector really concentrated, took on more risk than I think that they thought they were taking, because it was in such a tailwind. And I think if you were to break your rules here and keep adding because the dollar is weakening, you're taking on more risk than what you signed up for originally. And are you comfortable with that? And I'm not. We've already said I'm more risk adverse than you are. We know this. So for me, it's important to have these rules in place, especially you have to know your personality as well, I think. And some people like to take risks. I don't. We got a question on gold versus stocks. We got a similar question to this a couple of weeks ago, I have to say. But
I'm the same person.
I think they're asking if we took the cash value of gold, 1 kg in gold in 1997, and put it into our personal favorite stocks, would selling those stocks today buy more than 1 kg of gold?
I'm sorry, but I'm not even bothered to do the real, and it's no disrespect to the person asking the question, but this is something I just don't think about, and I don't really even care about this thinking. I'm just happy with my holdings, and where gold is today versus where it was a year ago, where it will be a year from now, I really don't care. I'm not interested in gold as such. I did talk a little bit about the other day, like, okay, what if the dollars, it's really the end of the dollar, would I have a little bit gold in my portfolio? Yes, I'm considering maybe having a little bit of gold in my portfolio in the future, but maybe you want to answer this question, Derek.
It's more of a hedge at the moment. But I mean, if you were to take our favorite companies, let's take Microsoft, for example. I have not done the maths either, but I would be almost certain that if I bought Microsoft in 1997, I would definitely be able to buy more than what I sold in gold in that. But like you, it's not, I don't like to compare these things. I mean, you can look at ETFs, you can look at gold, you can look at silver, you can look at growth stocks, you can look at crypto. And I find when you're looking in all these different places, your head is bobbling and you don't really have focus. And we spoke about rules, but you also have to have a goal. And if you're looking in 12 different directions, it's hard to focus in and reach your goal. And you might just feel like you're chasing after something and never really get there. And I think one thing I've learned and the best thing that's ever happened to me about this podcast is seeing the people like Jason that we spoke about, what discipline does in this, and sticking to one niche. You can have 1, 2 or 3 if you want, but sticking to a plan and knowing where you're going. And dividend growth investing is that for me. Comparing it against gold or silver is not going to, all it's going to do is annoy me if for no reason. So yeah. But yeah, companies like Microsoft, Apple, I don't have Apple, I know you had Apple, I would be almost certain that they outperform gold over that period of time. We got a couple of questions about AI disruption. John Clusterfee has asked us, are you worried about Anthropic going into legal services and financial research for companies such as Wolters Kluwer, or even companies like MSCI, Euronext, example? And will AI disrupt SaaS companies or boost them? So it's kind of a 2-part question there.
Yeah, and I think I spoke already a little bit earlier about that. I'm not worried. I do think there's competition, and there's the risk of some taking off some revenue from the traditional companies like Wolters Kluwer. But if I then see how the market responds to it and puts now Wolters Kluwer at a 12 or 13 PE, I think like, well, hold on, guys, this may be a little bit too early to judge about all of this. Yeah. So I'm much more bullish on a company like Wolters Kluwer. I didn't like it at 180 euros and the 60 euros. I started liking it a little bit at 120 euros. I started nibbling in under the 100 euros. So, this is for me the classical example of where value investing meets dividend growth investing. Yeah. And so I looked at Claude Legal here, and it is good for doing some basic work. I think it's more interesting for you and me to understand what's going on legally in our personal life and private situation. If I would be a lawyer, I would probably use the AI on top of a Wolters Kluwer database. Yeah, than an AI that's trained on the internet. Because that's what you need to remember. These databases from Wolters Kluwer are really unique. Like the moment there's a hacker that steals all the data from Wolters Kluwer and starts selling it to Anthropic and everything, then we are going to start to talk about different ballgame. But then still, is Anthropic going to hire all the lawyers that are commenting and everything on what was really happening in the courtroom there? I mean, maybe in the future this can happen by AI agent, but we're talking about the kind of data that Wolters Kluwer owns at this right moment in time. And people sometimes forget, like, building an app is easy, but try to maintain an app. Think about SaaS companies, because that's a question about as well. Think about SAP. Would you want to own a vibe-coded SAP solution? Would you like to maintain that one and be accountable in your corporate organization for the integration, for the operations that is up and running all the time? Would you like to be that? Already thinking that you get the imagination, which I think is really far off, to be able to do all the manufacturing, purchase orders, salary payments, everything now vibe coded. We may get there in the future. Who knows? That's why you need to own some companies that are also in AI, like Microsoft and Google. Yeah, but I find this on the too hard to imagine.
Yeah. I mean, there's lots of different theories and ways of looking at it. I mean, you speak of experienced lawyers at the moment, would they use AI? But then you think about, and I don't know if you see this,
lawyers do use AI today, Gen AI, a lot. It saves them lots of time in preparing documentation.
But think of the younger generation coming through, they rely on AI more than any of us. And I see this with graduate engineers or student engineers who are coming through. I can't ask them a question without going over and see that they're on AI asking about that. They could have the manufacturing book right beside them.
And that's fine. And that's why Relax is having all these AI agents on top of it.
Yeah.
So I think it's called Rel AI, Rely. Yeah. They have it. So those grads are coming on and they come into the workforce and say, like, where the hell is my AI agent? Where the hell is my LLM? Yeah, here it is. It's the Relax one. Make sure it's user friendly, I would say, to Relax and Wolters Kluwer. And they can do the way they are, but they can much better trust the data underneath it to support their workflows.
It's such an interesting case, and it's one that we will definitely look back in 5-6 years and say, we were right, we were wrong.
I mean, imagine being a lawyer standing in front of a judge and say, like, and the judge asks, like, how did you get to this? Oh, sorry, my AI hallucinated. Oh yeah, sorry. Now your guy needs to go 20 years to jail.
Like that's one big issue. Like, I think that would stop this. I don't know if it's a falling knife, but like, call this whole like scare tactic at the moment. Whereas if you had some litigation or some case where it was proving that AI was used and it was wrongfully convicted, I mean, it would open up a whole world of
yeah. But imagine you
worms.
being the person
on the end of
on
it,
the
yeah.
bench, yeah. And then you have your lawyer, and you see it chatting a little bit with Gemini about your court case. Would you feel comfortable?
Yeah. I mean, if I was sitting down with my lawyer and I seen him on a laptop and ChatGPT open, and how do I do an opening statement? I know I'm fucked.
You would also not want to pay this person 400 euros an hour.
Absolutely not. You're paying them for their expertise. To be fair, so yeah, I kind of agree with you. Like, it's too far fetched that it will completely take over. I mean, you have to have a human. Like the way it sounds at the moment is that AI is going to code everything. Then while it's coding everything, it's going to take everyone's jobs, and while it's taking everyone's jobs, it's going to do all these other stuff. It's going to be your lawyer. It's going to be your accountant. It's going to give you all the data that you need. It's doing everything. So what are we as people going to do? Just sit there with no money?
Split the G.
Yeah, we're not talking about that. I lost that, remember?
Yeah, but if that's the case, you need to invest in G.I. Joe now. But even the new generation doesn't drink alcohol. So I feel sorry for them, because what will they do?
Yeah.
We at least can go to the pub and have fun.
Okay, Basil has asked us.
There is risk here, right? These companies, if those companies are not, everyone has AI in the presentation, but you want to see execution. You want to see a pickup in usage, and you want management to be transparent about it, that their tools are actually being used. Yeah, that's what you want to see. If not, those would be red flags for me. Yeah, from RELX point of view, from what I saw in the earnings transcript, I'm quite okay with the with what they said. Yeah, looks like they're doing it well, and yeah, such things really help you making decisions, I would say. And you don't need to buy 100% of SaaS in your portfolio now. Why not 5% if you find a few good ones, right? Yeah, they may become 10%. They may become 0%. It's a risk.
It's a risk. Basil has said that he's off to Germany. Well, he was last week. I don't know if he's back. But what are your 3 favorite German stocks?
Siemens, Munich Re, Defama.
I thought you would have said Allianz. Siemens for me, Munch own machine, which I think I'm getting better at saying, I would say, and I would say Munich Re as well.
Yeah, did you study the Munich mentioned machine earnings the other day?
No, it's on. I actually
look at it. Look, I think you get a better yield now.
If you liked it under 50.
It's only dividend investors will understand the joke about yield.
Yes. Okay, some questions on big tech. MMAC, what do you think about Microsoft's growing reliance on OpenAI? Almost half of Azure's RPO is coming from OpenAI.
I actually read yesterday that they also want to move a little bit away from OpenAI and create their own models there. Yeah, I mean, we're talking about the order backlog here as well and everything, right? So I wish it was a bit lower. But on the other end, look at how much they earned from this position in OpenAI. Yeah, so I'm very appreciative to the strategic foresight that management had at the time to invest in it. This 10 billion that they invested at the time is worth a fortune now. I think, and this is what I love what they did, that Azure was the preferred vendor for running all these models. I mean, how clever was this to have this technology lock in there, right? So I think this was just very, very, very smart what Microsoft did there. Yeah, I hope they start now diversifying a little bit away from this, because I feel like ChatGPT is far behind on Gemini at the moment. So also kudos to Alphabet, what they did. It's the leap they took is I mean, books will be written about this, Derek, in a few years from now, what Google did there, from Bard, this little ugly man, to Gemini now that's shining with the whole integration. And then you hear people everywhere complaining about Copilot. I mean, yeah, the Google stack seems much more on top of it right now, and Microsoft should follow a little bit.
Different use cases, I would say. We use
Copilot. Of course, different use cases, of course, yeah.
And I have to say it's fantastic. And like you talk about using AI for productivity, and it's connected. I store a lot of stuff in OneNote in work, like troubleshooting guides or stuff that I pick up along the way, or store my files. I ask a question, boom, brings me straight to what I wrote down. I don't have to spend ages looking for. I mean, there's so many different use cases, but yeah, look, I think you're comparing apples and oranges a little bit. People are expecting Copilot to be like ChatGPT, but it's
true.
It's different. It's
anyway, hey. If you own both, yeah, you don't need to bet on the winner. You can just take the 2 best ones.
Yeah. We got a couple of questions from TJ and Medrad about the CEO carousel that happened between HP and PayPal.
Yeah, I think the CEO from HP that went to PayPal will regret at a certain moment in time. I think the PayPal story may be a little bit on the too hard pile, but let's see. I assume that he's already financially independent, so he can just take such a job at PayPal for the fun, and for the ego. That's how I think about it. I really will miss him. I find him a very strong CEO. He was doing all the right things so I really feel like a pity that he went to PayPal. I own both stocks, but PayPal is a little bit of a play for me in this small portfolio allocation that I have for growth stocks, which don't always grow. And so I wished him to spend more time at HP, which is my favorite subsidiary from that point of view.
Question from Forever Learning. Two frequently discussed stocks, okay? Evolution Gaming and Novo Nordisk. Both are facing pressures from revenue growth. Do you have any plans to cut position when you look at the headwinds, or only if there's a dividend cut?
Yeah, only if there would be a dividend cut.
Yeah. I don't own Novo Nordisk, so I can't say Evolution Gaming is a small position, and I knew the risk. I knew the risk going in there. And
of course.
Yeah.
Exactly.
I'm
dividend
happy
is there.
to take that.
The question is with Evolution having postponed their dividend announcement because they're trying to figure out what to do with their capital allocation. Now, imagine that they say, guys, you know what, at these prices, we will, let's say, not pay a dividend just for one single year because we want to buy back 10, 12% of our shares. And then we'll remain the dividend. What would you do? Technically, a dividend cut, you would keep
Technically a dividend cut, but I would keep it. It's such a small position in my portfolio. I would keep it, and it makes sense at these prices to buy back shares.
And also the stage at which this company is.
And I feel that if they did that, because it's not a dividend growth stock, right? So it doesn't appeal to, well, it is, but it's not classed as one. It was classed as a growth stock. But I think that the type of investors that were investing in this would appreciate more the EPS growth. And if they did that, their price might come back up to where I bought it from, and I can make a decision whether to keep it or sell it based on that. But look, as I said, I own 10 shares of that company. It's more so I like that space. Just watching that space and how it progresses is probably why I keep them. If it was a big position, if I had the conviction of, say, Wolf of Harcourt Street at some point, I would be having a different conversation. I would say. Yeah. But it's so small, it doesn't matter to me. MMAC has asked us about AbbVie, and how do you feel about their debt level and their dependency on just two drugs? I mean, it's 60% of their revenue in the last quarter. I don't own AbbVie. I remember owning them way back, and I sold them. I spoke about it on the podcast because at the time we were looking at dividend safety. I was restructuring my portfolio. I had 60, 70 positions, and I was just uncomfortable with their debt. I lost a lot of growth based on that dividend growth and price. I know you held on to them, but I wasn't comfortable with it at the time. I don't follow them that deeply, but with the debt level and dependency on two drugs, it would be a concern, but then what's that pipeline?
So I wish they were a little bit more aggressive on the paying down the debt. Yeah, management seems to be more comfortable than I am about it. And they seem to be more than on the acquisition path still. So I agree with him. But let's say I still sleep well at night. AbbVie is one of the stocks that I rarely check. Yeah, because I don't need to. Every time I just go to Twitter to look up dividend wave, and he shows me the charts again about how it's only going up and to the right. So, those are the easy ones to hold, in my opinion. Until it doesn't, of course. I think once those two drugs will go off patent, we'll get some share price worries again. But for now, I think, just let it ride. That more focus on the balance sheet would be nice if management is listening.
We've got some questions about some companies. What are your thoughts on T-Rowe price?
Disappointing.
Is it worrying in the long term?
Yeah, I don't like that continues to be an outflow. The only reason why the assets in the management are going up is because the stock market is going up. I am not happy enough with how they are entering into ETFs to support index investing. So this is really on my review list to potentially sell in May with my cleanup. I'm not in a hurry. This is a slow grower. Price is always a bit hovering around where it is now.
And a pristine balance sheet. It's hard to ignore that.
Exactly. No debt.
Christoph has asked us about European insurance stocks that we haven't spoke about. Is there any on your list, or even Canadian insurance companies?
So, you have MetLife in America. Chubb is headquartered in Switzerland, but I would say it's mostly an American company. You have Aflac as well that generates a lot of business in Japan. So those are a few. I just find them typically less interesting or less appealing than what the European equivalent's done. They're trading at much more higher multiples. I think it's also because of the inclusion in the S&P 500 and such. Those markets are already getting a higher multiple awarded. So if you're in those baskets, then that's probably why they are trading there. I find the European insurance stocks just stronger also in terms of performance.
Adrian has asked us about Edenred. He initiated a small position and he wants us to look past the poor investor relations site. I know we had Heavy Motor Investments on that spoke about these guys, but what are your thoughts about them in general?
Yeah, so I know that on a metrics basis, Adrian, this company looks good, yeah, as such. And it may be an interesting investment from that point of view. But this is where it comes to like the Peter Lynch style of investing, know what you own. And I know this company a little bit from a consumer point of view. And I have been with them and I don't like it. I don't like it at all. It's not just the investor relations website. It just created friction with me when our company used them. Yeah, like why not just give me cash in my hands? Yeah, so yeah, that's the issue that I have with it. So if you have a good feeling about the kind of business they are in and you feel positive about this, then based on these metrics, it may be very interesting. Yeah, but you need to have this feeling for a company. Yeah, it's also why I sold Viatris. Viatris at the time sold their main business unit that I was interested in. That was my catalyst. They sold it. So then I don't know what it is anymore. And that's why I sold it. Yeah, I can't own it then anymore.
Yeah. I mean, from a metric perspective, it does look quite decent, I would say, and their dividend profile does look relatively safe. You get a decent yield for them at the moment. A regular dividend history for me, and again, look, like European DJI said, you have to have a feel about that type of company. For me, I don't know. I struggle to see long-term growth with these types of companies, but again, that's probably more my ignorance than understanding the company than what's actually there. If I remember, I looked into them briefly after Heavy Mode, and I think the one thing that kind of stood out to me was they were heavily leveraged, if I remember correctly. I don't have the numbers in front of me, so I'm just trying to work off memory. That was one thing that kind of stood out to me. So yeah, look, purely from a metric, I'm looking here online. I can see why they like it. The debt was a concern for me, but like you, I don't have a feeling for that company. It's hard to comment other than to say that metrics wise, I can see why you would look at that company. First has pitched the company back to us in 2024 called Sverbergs Group. When it was trading around 30 Swedish crowns. It's now around 70 Swedish crowns. He's saying it is a terrific company in the European bathroom market. Any chance you'd revisit this on your podcast, even if it has a lower yield and a regular dividend history? Them last two lines say it all for me. I think if you listen to this podcast, we talk about dividend safety a lot, and a company has to be quite special for me if it has an irregular dividend for me to be interested in that. And by that, it must have some long-term growth trajectory. I look at a company like this and I see bathroom products. And again, it's probably my ignorance again with understanding the company, but I mean, you're looking at furniture, showers, bathtubs, mirrors, accessories. How much growth can you do out of that? How much innovation can you do with that? You have to try and attract new customers. I know they're expanding into the UK. They're primarily in the Nordic industry. But I struggle. To me, they're not sleep well at night companies. Maybe you might like to own them for a short period. But yeah, I quite struggle with that. So the fact they have a regular dividend history, the fact that the yield is lower than what I like, the fact that it is in an industry that I think is easily disruptible, and it's just, there are various brands within a group. Yeah, for me, it's not a company I like to look at. I don't know how you feel on these types.
Same. Irregular dividends don't fit my portfolio.
Yeah, but again, the numbers look good right now. It just doesn't fit my profile. But glad it's doubled or over doubled in share price for Aferis. The last question then comes from Hussein, and it's about real estate and Las Vegas, baby. Vegas is still very popular destination at the moment, but online habits are affecting gambling as well as so he's talking about different types of generations, gambling online, not gambling online, and do we think that this will have an impact on Vici and Vegas in general?
So potentially, yeah. We have Evolution AB as well. But I do believe that people always look for entertainment. And we sometimes talk about Gen Z, but they're in their early 20s. Yeah, let's say. So we as millennials, I don't know, I was not interested in gambling ever, actually, but I see people start to spend more on gambling once they have disposable income. When you're a student, it's a bit different. So we're looking at a generation that is still being prepared to be gamblers.
Yeah, but like, I know Vici, right, is heavily reliant on Vegas. But what Vici are, like, what Evolution Gaming, for example, is doing on this online generation, that's for gamblers. That's for people who are trying to make a quick buck easy, may or may not have a problem, and trying to do that. Vegas is different. It does try and extract as much money out of you as possible, but it's an experience. I think that's what people go to Vegas for. And a lot of people go to Vegas going there with the intention not to win money. There's people that will, but they will go there for the experience. I've been to Vegas and I mean, I've been there 2 times, and I remember the second time, it's so funny, we were even queuing up in the hotel, and the words that I heard was constantly, "It's Vegas, baby." Do you know what I mean? They don't care about paying high prices. It's Vegas, only in Vegas. That's all you'll hear. So it's more of an experience than a gambling. So if you're looking at it from a gambling perspective, yes, online will take over Vegas. They're not going to go to Vegas to gamble to make serious money. If they make serious money, they'll probably get kicked out of the casinos anyway. But they go to Vegas for the experience. My experience over there was people are happy to spend large amounts of money, not just in casinos, outside of casinos. So I think Fiji is pretty safe for a good few years yet. So that's the distinction for me. That's it. We got through. I can't believe this was 1 hour and 20 minutes. Honestly, it felt like half
many
an hour.
Questions still from last year.
It didn't feel like that long. Again, thanks for all the questions. We finally got to them. You can see why we didn't do it last week. The show would have been 2 hours. But we do really appreciate all the questions. Lots of stuff to keep us thinking about. And as always, hope you enjoyed the show, and we will see you all next week.